Hey Bowtie Nation, Joseph Hogue here, and following up on our Just One Stock series. After the huge success of our first video on dividend stocks last week, you asked a question I had to answer. What is the one index fund investors should be buying right now? I'll leave a link to the first video in the description below. We'll be covering all the strategies here, from value investing to growth, tech, dividends, and by the end of the series, you'll have a portfolio of the very best stocks to buy. Make sure you join the community, tap that subscribe button so you don't miss any of these, because it's going to be a complete portfolio of the best stocks. I want to get right into that list of the best index funds, so we'll save for later why every investor needs an index fund in their portfolio and the 3 things you absolutely must look for when you're buying a fund. First though, I also want to personally invite you to get the Weekly Bowtie, our free weekly newsletter with all the stock market news, strategies, and trends you need to know. Each week before the market opens, I'll show you what I'm watching and the stocks that could highlight the week. It's all totally free, just something I like to do for all you out there in the community, so look for that sign up link below. First up is 2 of the most widely held index funds, the Spider S&P 500 Trust, ticker SPY, or the Vanguard S&P 500 Index, ticker VOO. These are basically the same fund because they track the S&P 500 Index so closely, and here in this chart you can see that with the 2 funds and the index. But now I do prefer the Vanguard fund, and I'm going to tell you why when we look at what to look for in an index fund later. The Vanguard fund covers the S&P 500, which means it holds the 500 largest companies in the United States, titans like Apple, Microsoft, and Amazon. It also means, just like the index, it's got 1/4 of the assets in tech stocks, and 64% of the fund is in just 4 sectors, so not quite as spread out as you might like. Now, the fund does pay a 1.6% dividend yield and charges a super low expense ratio of just 0.03%. It's basically nothing, just 30 cents a year on every $1,000 you have invested. Now, but the problem here is there is also a lot missing from the VOO and any S&P 500 index fund. It's holding those 500 largest companies, but has no exposure to small cap companies or many of the growth stocks that have helped the NASDAQ outperform over the last few years. It also doesn't have those international stocks. Now, the $40 trillion market cap for the S&P 500 companies is nearly half the total $93 trillion market value of all global stocks, but it does leave a lot out. We've still got 4 more index funds to highlight, including the top pick of all, but I want to explain these because I know there are a lot of misconceptions out there. An index fund is a group of investments bundled together, and then shares of the entire group are sold to investors. Buying a share of the fund means you get the returns on everything in the group instead of having to buy hundreds or thousands of stocks separately, and for this, you pay a percentage fee to the manager. Now, this might sound a lot like an exchange-traded fund, an ETF, and it's because index funds are sold as ETFs or mutual funds. You buy them just like stocks, and most you can buy with no commission. Now, where the confusion sets in is not all ETFs are index funds. You see, index funds invest in a broad benchmark group like the S&P 500 or the NASDAQ. The manager just replicates that index, so they're investing passively and really have no control over what goes into the fund. And that's different from a lot of theme ETFs, like, for example, the Vanguard High Dividend Yield Fund, ticker VYM, which I also like but is not a true index fund. The VYM, like other non-index funds, bases its investments off a strategy or a theme, in this case, companies that pay above average dividend yields. By comparison, the S&P 500 is a broad stock market index. The NASDAQ 100 is a broad index of the 100 largest non-financial companies listed on that exchange, so more broadly defined and inclusive of all stocks in that group. Okay, by now I know half of you are screaming, get on with it already, but the difference is hugely important and why every investor needs an index fund in their portfolio. Buying an index fund means you get that broad market exposure. You are the market, and you know you're going to get that diversification and the return that you can only get from the entire market. Theme ETFs and dividends or growth or value stocks are great, and I'm planning a video on those as well, but investors don't realize what they're missing. Let's look at that Vanguard Dividend Fund, the VYM, versus a true index fund, the Spider S&P 500 Trust, that SPY. The VYM holds almost 500 stocks, so you'd think your risk is spread out pretty well. But if you look at the weights of each sector in the fund, that picture starts to change. The stocks in just 4 sectors, consumer staples, energy, financials, and healthcare, make up more than 57% of the fund. And just 4 of the 11 sectors of the economy are more than half the fund. And when you compare the stocks in the VYM with those in the S&P 500, so what most people consider as the benchmark for the stock market, it's a completely different picture. For example, more than 27% of the S&P 500 index is in tech stocks, while the group only makes up about 6.9% in that VYM ETF. Energy stocks make up about 10% of the dividend fund, more than twice the exposure in the overall market. Now, this is not to say that the VYM or those other theme ETFs are not good investments. They are, and I'm going to show you which ones to buy in another video, but you are not getting that broad market exposure and the risk reduction that you can only get with a true index fund. Where the S&P index funds were missing those growth stocks, the Invesco QQQ Trust has all the growth you need, tracking the NASDAQ 100 index. The fund invests in the 100 largest non-financial companies in the NASDAQ index, and there is some overlap with those S&P 500 companies, but it's much more focused on tech. And that's more obvious when you look at the sector weightings, with tech stocks making up half of the portfolio and just the top 3 sectors making up 84% of the assets. The dividend yield here is only 0.74%, but that focus on growth has helped it nearly double the return on the S&P 500 over the last 5 years, even though the fund is a little bit more expensive at 0.2% a year. But just like those S&P index funds, there is still a lot missing here, and that focus on growth comes at a cost. Because half the fund is in tech stocks, it falls harder in a crash, with the QQQ down 30% this year versus just 20% for the S&P 500. And just like that S&P 500 fund, though, it also lacks any exposure to small cap companies and international stocks. One type of asset we haven't talked about yet, bonds, and the Vanguard Total Bond Market Index, ticker BND. And before I get all kinds of hate comments about bonds being shit this year, the BND is only down 9%, including the dividend. So even in that sell-off on rates, it has protected your money from a lot of the market crash. The fund invests across quality US dollar-denominated bonds, including government, domestic, and even some international exposure, with more than 10,000 bonds in the portfolio. It pays a solid 3.4% dividend yield and gives you that exposure to an entire asset class for a little safety outside of stocks. Of course, this wouldn't be the only index fund you hold, because you'd miss out on that growth that only comes from stocks, but it is a good addition to a portfolio. It also doesn't have those high yield bonds, which are lower credit quality but higher return, or any exposure to other asset classes like real estate or commodities. 2 more index funds to watch, but all you out there in the nation know I'm not just about dropping a list of stocks in your lap and saying go buy these. I want to show you what to look for in an index fund, how to find these investments on your own. And for that, it all comes down to 3 simple things you want to look for and then compare across index funds to find the best one for your portfolio. First, you want an index fund that is as broad as possible, one that covers the entire market. This is your chance to be the market, not have to worry about picking that one stock out of the 4,000 traded in the US market. Even better though, there are funds that will give you exposure to international stocks as well. You also want a fund that isn't going to duplicate too much of the other ETFs or stocks in your portfolio. And this is why I say the best fund for your portfolio, because it might be different from the best fund for my portfolio or someone else's. For example, if you already own something like maybe the NASDAQ 100 Covered Call ETF, that QYLD, then adding the NASDAQ Index ETF, that QQQ, is just going to double up your exposure to the same tech stocks. And that's not usually so much a problem with individual stocks, because most index funds only have a few percent in each stock. But if you own any theme ETFs that invest narrowly in a group of stocks, just make sure it's not the same group that's in your index fund. You can always see exactly what stocks are in an index fund or an ETF by going to its website and looking for either the holdings or portfolio menu item. This is going to show you the stocks as well as the sector breakdowns for a fund. And here's something you want to do for all ETFs and index funds before you invest. Check that expense ratio. This is the annual percentage fee charged by the fund manager, and the lower the better. Most index funds charge very low fees because they're passively managing these assets. The fund manager just buys what's in the index, so there isn't much analysis to do. For example, the fund I'm going to show you next charges 0.07%, which would mean just 70 cents for every $1,000 invested. Now, it's usually more important on those theme ETFs because these can get really expensive, like the 0.75% expense fee on the ARK Invest funds. And this is also why I preferred that Vanguard S&P fund, the VOO, against the SPY earlier, because of that expense ratio. The SPY charges 0.09%, while the VOO is just 0.03%. And while that's only a difference of about $6 for every $10,000 invested, It's the exact same investment, so I'm going to take my $6 and buy an extra mocha coca cappuccino. This next index fund, the Vanguard Developed Markets ETF, ticker VEA, gives you access to another part of the market that most investors are lacking. The fund invests in a diversified mix of small, mid, and large cap companies across the developed world, including Canada, Europe, and the Pacific. There's more than 4,100 companies here, and some of the most recognizable brands, including Nestle, Samsung, and Toyota. The fund pays a 2.5% dividend yield, well above what you get with the S&P 500, and provides that exposure to international stocks in an easy, all-in-one package. It is down 18% so far this year, slightly less than the US market, so providing a little protection in that international diversification. But now, even with that 4,100 stocks, there are still some parts of the market missing from this fund. First, it doesn't hold any US stocks, so you need to pair it with an S&P 500 fund like the VOO. It also doesn't hold any emerging market stocks or asset classes like bonds. Next, I'll reveal the best index fund for your money, the one that has it all. But don't forget to catch the first video in our one stock series, a value stock with a 60% plus upside potential. I also want to get your input on this too, though. What other themes do you want to see covered in that one stock series? I'm planning on doing ETFs, growth stocks, and penny stocks, but let me know in the comments what theme or investing strategy do you want to see. The broadest, most inclusive index fund you can buy, the Vanguard Total World Stock Fund, ticker VT. The Total World Index gives you everything in the S&P 500 and the VEA, but also emerging markets and smaller companies. You've got small caps, large caps, developed, emerging, and US stocks. Looking at the top 10, it seems to be just a rehash of the US stocks, but with almost 9,500 stocks in this fund, it pretty much has everything. Now, the dividend yield isn't spectacular, but does pay 1.65%, and the fund has produced a 9% annual return over the last decade for an expense ratio of just 0.07% annually. But now, not even a total market index can give you everything you want. The fund does lack exposure to other asset classes like bonds, though it does have real estate stocks in it. You will notice a lot of overlap with that S&P 500 fund, so you probably don't need two of those together. Click on the video to the right for the one value stock every investor should own, the first in our series of best stocks to buy right now. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.